All right, let's just jump straight into this. Welcome to today's explainer, where we're going to unpack a massive, fundamental shift in the AI economy. One that actually happened right in plain sight back in mid-July of 2026. For the longest time, the market was perfectly happy to reward companies just for trying to build AI capabilities, just for the effort alone. But then, almost overnight, the rules completely changed. The tape literally stopped paying for effort. So if you want to understand how the entire future of tech, consulting, and AI services is being completely rewritten right now, you are definitely in the right place.
Here's the roadmap for our explainer today. First up, a tale of two tapes. Second, the realization gap. Third, the canary in the mine. Fourth, three bad roads. And finally, we'll wrap up with the fourth road.
All right, starting with part one, a tale of two tapes.
So mid-July 2026, we have two major tech giants, both operating in the exact same AI boom, right? But they experience completely opposite market reactions, just 5 days apart from each other. On one hand, you have TSMC reporting an absolute monster of a record quarter, revenue up 36%. Why? Well, because they get paid for verified capacity. We're talking literal, physical wafers out the door that the customer can actually hold and measure. On the flip side, IBM's services division pre-releases a massive miss. And their model? They get paid for effort. They get paid for timing. It's all about hours booked and deals they just forecast will eventually close. Now, a lazy read of the situation is just, oh, hardware beats software. But that's totally wrong. They are both selling to the exact same AI demand. The fundamental difference here, the real secret, is how they actually get paid. One is anchored to verifiable physical reality, and the other is just anchored to a forecast. And when the market finally decided which of those two models it trusted, wow, the consequences were just brutal. $67 billion. Just let that staggeringly huge number sink in for a second. That is the amount of market value IBM shed in a single day. The worst day on record for them. This wasn't some slow, gradual leak. It was an immediate, violent repricing by a market that suddenly woke up and stopped believing in an effort-based revenue model. But here is the really fascinating part. Following that brutal drop, Wall Street analysts rushed in to slash their price targets for IBM across the board, but strangely enough, they mostly kept their buy ratings. Think about what that actually means. The market wasn't punishing IBM's core franchise or their underlying tech. No, they were simply repricing the forecast. They were essentially saying, hey, we still believe in your platform, for sure, but there is absolutely no way we are going to keep paying you in advance for unverified effort. Which brings us to part two, the realization gap. Let's really diagnose the root cause of this brutal market reaction. It all comes down to an incredibly powerful concept called the realization gap. Think of it as the distance between what a company claims is in their sales pipeline, what they say they're going to do, and the actual verifiable results a customer can confirm. Now, in a roaring bull market, nobody checks the gap. Bookings are just treated as revenue and waiting. Everyone's happy. But the second a quarter comes in even a little bit soft, the market wakes up. It suddenly realizes it's been pricing in this optimistic narrative that it cannot actually check. The gap itself doesn't cause the earnings miss, but the gap is absolutely what turns a routine earnings miss into a massive, panic-inducing repricing event. So the money didn't just vanish into thin air, right? It just moved. Listen to IBM's own CEO, Arvind Krishna. He flat out noted that customers were redirecting their capital towards servers, storage, and memory, and he actually admitted that their culture had been too slow to change. He was literally watching the money migrate from that effort layer of services and forecasted deals straight down into the capacity layer, the tangible hardware you can actually point to and verify. Let's zoom out a bit for part three, the canary in the mine. Because IBM was absolutely not an isolated incident. They were just the canary in the coal mine for the entire global enterprise tech ecosystem. Look at the massive global integrators, firms like Deloitte, TCS, Accenture, EY, Capgemini. Every single one of them runs on that exact same effort-based model that just got repriced at IBM. They bill against pipeline and utilization. So when corporate IT budgets decide to stop paying for vague consulting hours and shift toward paying for verified capacity, every one of these giants is suddenly standing on incredibly shaky ground. The market is now completely wired to demand proof. And the threat isn't just coming from clients tightening their belts, it's coming from totally new, aggressive competitors entering the space. Literally one day after IBM's massive miss, a $1.5 billion insurgent launched. It's called Olade with Anthropic, and it's backed by heavyweights like Blackstone. They aren't billing for effort at all. They are embedding forward-deployed engineers into mid-sized companies and billing purely on verified outcomes.
So the old guard is getting completely squeezed from the hardware side below and this agile new services side above.
All right, part 4. 3 bad roads.
Let's talk corporate strategy for a second. If you are a mid-cap company right now trying to survive and reinvent yourself with AI, you usually face a few harsh choices. Let's call them the 3 roads, and honestly, they're all pretty bad. Road 1, you write the check. You try to fund a 9-figure AI build all by yourself. The fatal flaw? Mid-caps literally can't afford it, and they can't hire the top-tier talent to pull it off anyway. Road 2, you sell at the trough. You sell out to a holding company like Prometheus that will apply the AI for you. The flaw there is you surrender all the future upside of your own franchise. And Road 3, you buy a pilot. You hire a big strategy house for a contained proof of concept. The problem? Sure, it looks absolutely amazing in a slide deck for the committee, but it never actually moves the needle on your profit and loss statement. So what do? That brings us to part 5, the 4th road. If those traditional 3 roads lead to a dead end, how do you actually survive this shift? The solution that completely closes that realization gap relies on a totally new gain share model. We can call it the winner's triad. Here is how it actually works. First, the integration partner funds the AI build with their own capital at risk. Second, they create a commitment object, which is just a durable, locked record of the baseline and decisions. Third, they submit the final results to a completely independent audit. And here's the absolute kicker. The partner firm only earns their money on certified EBITDA growth, basically your verified operating profit. They earn 0 until they can mathematically prove they made you money. Picture an even 50-50 split of those newly generated verified dollars between the client and the integrator. Structuring an agreement this way fundamentally rewires the culture of both companies. There's no more hiding behind good effort or billable hours. If the AI doesn't actually work, the partner loses their investment. If it does work, they share in a massive upside. It forces absolutely everyone to pull in the exact same direction for the exact same verified outcome. Let's make this super concrete with a fictional mid-cap manufacturer. Let's just call them Dunder Mifflin. Say they have underperforming plants and their stock multiples in distress. Instead of paying millions for a fancy consulting deck, they use this gain share model. They fix their factory under absorption, which is essentially bleeding money on idle machine time, using an embedded AI team. Within the first year, they generate $40 to $60 million of independently certified EBITDA. Now, when that audited number hits the tape, Wall Street has no choice but to revise its models. The company's multiple re-rates, it lifts them entirely out of takeover danger, they get to keep their company, and the partner gets rich alongside them. It is the ultimate win-win. And this isn't just some theoretical whiteboard exercise. Real companies are already demanding and getting this verified physical output. BMW is building digital twins across more than 30 sites using NVIDIA's platform. Unilever completely slashed their product imaging costs the same way. PepsiCo is catching 90% of issues before anyone even touches a machine on the factory floor. Kion is running entire warehouse digital twins managed by Accenture, where the integrator manages the KPIs. The enterprise buyer has officially stopped paying for slides. They are paying for proof. So, I'll leave you with this final thought. As we all navigate this massive shift in the AI economy, look really closely at your own company's strategy. Is your AI reinvention tied to hard, audited proof that actually hits the bottom line? Or are you just paying for a forecast that the market has already learned to heavily discount because the tape stopped paying for effort? The only question now is how quickly you are going to adapt. Thanks for joining me on this explainer, and I'll catch you on the next one.